I had the pleasure of working with Keith and Bobby this past quarter. We closed their home equity conversion mortgage and changed their lifestyle. The genesis of the conversation with Bobby and Keith started around owning their home with a small balance remaining, but trying to make those payments living off Social Security. They were feeling the constraints of the economy right now. Social Security, they were making roughly $4,000 a month on Social Security. Their debts between car payments and mortgages was roughly $3,000 total. They were feeling the constraints, and we exercised what would a reverse mortgage look like? What would a HELOC look like? What would it look like to sell the home and try to downsize with the reverse for purchase? It ultimately landed on they wanted to stay where they had raised their kids, in the home that they grew up in. And the home equity conversion mortgage made that possible by eliminating that existing remaining principal balance from the first mortgage. They were able to get a line of credit where they paid off both of their car loans. So they were able to move their debts, their monthly reoccurring debts, from about roughly $3,000 down to zero, while still being able to live off of that $4,000 a month of Social Security. They were also the beneficiaries of having a line of credit that grows over time. They now have assets to draw from the home they live in. They have their Social Security, and they remove their 3 largest debts every month, realizing that the home equity conversion mortgage was the best fit for their lifestyle, but also changed their standard of life. They are now able to, they sent me photos this week of them on a cruise in Mexico, using the funds from their reverse mortgage to take a little time to treat themselves, as they should. They worked their tails off their whole life. Now they get the opportunity to go take a vacation with the home that paid for this, that they worked their tail off to pay that home down. It's your time to leverage that, and you should be able to treat yourself within reason, financially responsible, to go on vacation and treat yourself and enjoy the days of retirement, not stressing about monthly payments. We've all felt how it feels to make your payment on February 1st, only to drag your feet in dread making that March 1st payment and pinching pennies for the next 30 days. We were able to relieve that through them by using a home equity conversion mortgage. So this is what it looks like, and there's a lot of misinformation and a lot of retooling around these home equity conversion mortgages. But they work similarly to a forward mortgage. And the best way I can describe that is showing you this graph. So on a traditional forward mortgage, you come in with a piece of equity, typically your down payment. Over time, you pay the bank, your loan goes down, and your equity will increase over time. You're with me. The HECM's gonna work rough in the inverse. You're starting with a large piece of equity on the home you either own free and clear or have a great equity position in already. The bank will pay you over time. So as you can see, your equity will go down over time as the loan balance grows. The value, we still have the value climbing as we do for real estate. However, bank pays you or you pay bank. Forward mortgage, HECM. So with the line of credit, how does that work over time? Is it a fixed amount on my line of credit? No. Bobby and Keith are realizing the growth of the line of credit. So yes, you can pull from it like a traditional HELOC, pull the funds, spend them as cash, and the loan balance will climb, right, as you draw from it. But the other advantage of a HECM is that line of credit grows over time as well. So as your home rises in value, so will the available equity in line of credit. You're guaranteed a rate of return off of what today's current interest rates are. So even as you spend from it, it will grow incrementally over time, allowing you to still have a bit of liquidity, even if I max it out year 1. Year 2, you'll unlock a little bit more of equity. The 3rd year, a little bit more. The 4th year, a little bit more. Age plays a big determining factor in the HECM. Equity in the home is also a big factor. The younger you are, because it starts when you're eligible at 62 years old and own a home. The older you are, and when you start the reverse mortgage, the more equity is available to you. We get this the ideal client for a retirement mortgage. This is for people who are 62 and over and own their home. And the needs can vary. Oftentimes the constraints we see are couples or seniors that are living off of Social Security or fixed income. and they have the rising costs of the world around us. I'm sure we've all been to the grocery store recently, regardless of region, county, city, or state, and seen the prices of groceries climb up on you. When you're on a fixed income, that eats into your available cash. We often see people who have lots of medical expenses as well that might not be on Medicaid or Medicare that are paying for these treatments or paying for these specialties out of Social Security. You're sitting on the largest asset that you own, which is your home. And it's okay and oftentimes encouraged to leverage that in retirement so you can have a better lifestyle and a more healthy, fulfilling life. Now, you might be thinking to yourself, I have an IRA, I have a 401k, I have my Social Security and a pension. I'm not worried about that. I'll be good to go. I take my quarterly or monthly disbursements from my retirement that I saved up for. Good for you. But I'd be willing to argue that leveraging your 401k for disbursements, giving you broaden your horizons and being able to pull from your reverse mortgage line of credit, it gives you options with your financial advisor to leverage when is the best time to pull from my retirement assets and when is the best time to leverage my line of credit from my reverse mortgage. A detailed plan sitting down with your financial advisor is the best way to concoct what's the most tax advantaged way to leverage my income for retirement. This takes place in many shapes and forms. We preach here the coordinated withdrawal strategy. This was concocted by economists in the Midwest and has been a proven recipe for a successful retirement. How this takes place or how this works is we have our pool of traditional assets, 401ks, IRAs, pensions, and we leverage that off of down or up markets. And when is the best time to pull and take your disbursement? Oftentimes, it might be advantageous to you to let the money run in the market, let it to continue to climb, and pull a little bit from your reverse mortgage line of credit. The financial advisor has more money and capital of yours to invest to elongate your retirement. And then if there's another time where maybe the market's down or not performing well, and we have a chance to take some losses to help your taxes, that might be the time to take a disbursement from your 401k, IRA, and then we can let the reverse mortgage line of credit grow over time. We're focused on trying to create financially healthy seniors so they can go on and enjoy retirement and enjoy all the time spent working up to spend time with your family and loved ones. Why not have more tools available to you to leverage? Now you're probably thinking, what's this gonna cost me? Well, I know there's strings attached for everything, and you're right. But here's how it works. When there are costs associated with doing a reverse mortgage, there are costs associated with buying a house, with selling a house. There's costs associated with missing opportunities. But what I like to focus on is what the costs will unlock for you and the protection these costs might give you in the long run. A home equity conversion mortgage, or a HECM, will have closing costs, but specifically FHA mortgage insurance. Now, I think this works in the consumer's advantage because the FHA mortgage insurance is there to guarantee values, sans another 2009 event. We all remember the nightmare that caused for us and our loved ones, and how do we not repeat history? The FHA Mortgage Insurance Fund was created to do exactly that. Protect home values, but specifically protect consumers in the event that home values did take a dive. So the FHA mortgage insurance is oftentimes the largest closing costs associated with a reverse mortgage, but it's really there to protect you. These costs do not come out of pocket, can be taken out of the loan when originating it. So yes, you are paying these costs, but if you were to sell your home, there would be costs associated. If you want to put it in a trust and hand it down to your kids, there's costs associated. And my point being is there's opportunity cost and then there's financial costs. The closing costs associated with a reverse mortgage help mitigate risk for you in the long run and open up opportunities available to you that weren't there before. Next common question that comes up like clockwork every consultation. What do I do with the house when I'm done with it? I want to give it to the kids. I want to give it to the grandkids. I'd like to make a charitable donation to this. Well, also associated with those costs is a protection for you in the event that home prices or home values do tank. On a forward mortgage, it's recourse debt, and they have the authority to go after, the banks do, authority to go after other assets to recoup the loss. The reverse mortgage does not. It's non-recourse debt, so in the event home values did go down, the only person who can take the loss is the lender, and they get to leverage the FHA mortgage insurance pool that you already paid into. So this is a cleaner opportunity too for you and your family to be able to pass the family home down. It protects you and also allows the kids to have an opportunity to purchase the home after. There is an exit strategy, and we do go through that with our clients and their trusted loved ones if need be. Heirs, you got to be asking yourselves, okay, my mom had done the reverse mortgage. It's been 3-4 years. The loan balance has grown over time, and we have less equity available. There's still equity available. There's a couple of ways you can go about this. Oftentimes, the heirs will sell the property and take the remaining equity and split it up amongst the heirs. That's a clean and simple solution. We've also had scenarios where the heirs would like to purchase the home and inherit it back that way. That is very simple as well. It involves paying off the remaining loan balance like you would on a forward mortgage, and then having a closing to put put the property into your or the heirs' names. Now I know what you might be thinking. I don't want to leave my heirs a pile of debt to clean up, sort through when I'm done with the property. It's simpler than you think. At Freestone, we've heard a lot of it too. I don't want to leave my heirs a mountain of debt. I don't want them to have to deal with the messy cleanup when I'm done with the property. And you have a point. That is a valid point. But what we like to push back on is to think about it maybe a little bit differently. What does it look like if I don't go forward with the retirement mortgage? What costs does that leave my heirs now helping take care of me? Let the house pay for the debt itself, and then we can have a clean break there, as opposed to trying to pay for it all now while pinching dollars together to pay for end-of-life care. We've heard it all here at Freestone. I don't want to leave my heirs a mountain of debt to deal with. I want to leave them a fully paid off house, so I'm committed to paying down my balance to zero, because I want to be able to gift my kids a free and clear house. And I love that attitude. However, I challenge you to think about it a little bit differently. If in order to do that, if we didn't have the retirement mortgage, the burden would be on the heirs to pay for end-of-life care now. I would rather know that my loved ones are taken care of, meeting all of their needs, as opposed to leaving me a paid off free and clear home. Oftentimes, there's deferred maintenance. There is an older home that might be in a different location that was ideal for me to inherit. I might live in another state, city, work on the other side of town, and it might not be the best move for me. So oftentimes, heirs would rather have you have a higher quality of life, knowing that you're safe, you're taken care of, your bills are paid, and you have opportunities to go explore the world and spend time with the loved ones now, as opposed to whittling everything away to stay in this home and gift it down. Let's take care of ourselves now. And oftentimes heirs would agree to take care of yourselves and use the cash and the funds that you had saved up with building wealth through real estate. It's time to leverage that and take care of ourselves. And oftentimes too, it would cost the heirs money now to help pay and cover the costs of some of these things if we didn't use a reverse mortgage. Let's talk about using a retirement mortgage to pay for end-of-life care. Oftentimes, end-of-life care is expensive and can cause fear and panic among families. How are we going to pay for this? And oftentimes, we're sitting in the living room of the house discussing where we're going to find the money to pay for end-of-life care. Using the reverse mortgage to pay for end-of-life care has numerous benefits, but specifically being able to age in place in the safety and comfort of your own home is a big one. Being able to bring care into the home and paying that premium using the retirement mortgage to do so removes the burden from the heirs having to pay for that now, knowing we have an asset we're sitting on that we can leverage to pay for end-of-life care. Using that retirement mortgage to pay for that can remove burdens from heirs, can be an efficient way to age in place safely and securely, and also get the necessary medical attention while in the comfort of this weekly. When is the right time to do the reverse mortgage? And it's a great question. And oftentimes we encourage those to be proactive in their retirement planning. Start the conversation early. Kick the tires to see if the timing's right to do a reverse mortgage. But advantages of being early and proactive in the reverse mortgage planning comes in the form of that line of credit growth we referenced earlier. The longer the credit line is open, the longer and higher it will grow. That being said, knowing that we have a retirement mortgage line of credit set up does not necessarily mean we have to pull from it right away. We can let the cake bake, let the credit grow over time. My grandma specifically did this. She was well off financially. She did not need a reverse mortgage, but working in the mortgage industry, she saw and realized the value of opening up the line of credit as a just in case when she was earlier in retirement, allows her now to leverage it at 77, 78 years old. Of now, I haven't pulled from it for a decade. It's grown exponentially from when I opened that retirement mortgage 10 years ago. And now is the right time to leverage that. Give yourselves more opportunities. Be the one holding more cards than less cards and have opportunities to play for yourself. We live in a weird time. I don't need to tell you that, but having more opportunities and ways out of pickles now is better for you. Hold the cards, then you can make the decision maker, and then you're not forced into being put into a decision. You can drive your destiny, and it all starts with a conversation around timing. Reach out to your financial advisor. Reach out to us and talk about retirement mortgages. We don't just do retirement mortgages, we do all mortgages. There might be a better loan that's a fit for you. However, oftentimes, this retirement mortgage is a great opportunity to leverage the home you live in, not have to put stress on heirs or other retirement assets, and keep your quality and standard of life high as you enjoy the last days of your retirement.